On the right side of our equation, our liabilities are what the business owes. Current liability will be due within 1 year, so it is a short-term account. So that's your wages and salaries payable, accounts payable, taxes payable, and short-term notes payable, because all of these are expected to be paid within 1 year. So then any obligation that is due over a year is going to be a long-term liability. So leases payable, bonds payable, warranty liabilities, those are our long-term obligations. We can come across a few uncertainties when it comes to our liabilities in regard to who we owe money to, how much we owe, and then when we owe it. So when Dyson sells its hair dryers with a 1-year warranty, Dyson may have to pay for the future repairs, but this is not clear. They also don't know who will need the repairs from all their customers who bought their hairdryer with the warranty. That repair amount is also uncertain because they do not know how badly damaged the hairdryer is and therefore the cost of that repair. These amounts will be estimated, but they are not certain. But we also have known liabilities where we know who we owe, how much we owe them, and when we owe it. So there is accounts payable, which is our base liability account. So any products or services that you bought on credit from a supplier is going to be recorded in this account. No one likes them, but the sales tax that the seller collects from the customer is going to be forwarded to the government. It's a current liability that the business owes the government from their sales, and it's going to be recorded in the sales tax payable account. Account names are pretty self-explanatory because accounting is not meant to be interpreted. It's supposed to be transparent. If a customer pays us in advance for a product or service that we have not yet delivered on, we're going to record this in our unearned revenue account. We went over in an earlier video that notes receivable is the principal and interest that a customer owes our business, but a short-term notes payable is now going to be the principal and interest our business owes the payee within a year. We can use short-term notes to borrow money from a bank or to replace accounts payable that we might be overdue on. Payroll liabilities are the amounts the employer owes to its employees for working for them, and then the benefits and taxes fall on the employer. From the employee's side, gross pay is going to be the money you theoretically earned, but you are not walking away with all of that because there are deductions like taxes. After you deduct all your payroll withholdings, you are left with your net pay, which is the money that actually goes into your bank account. So your employer is going to take out of your gross pay what is known as FICA taxes. That is your Social Security and your Medicare taxes. Then the employer will also collect the income tax, so that's another slash at your gross pay. Then there are voluntary deductions that an employee can request to be removed from their gross pay. Think your medical and life insurances, unions, and pensions. They are going to be reported as current liabilities on the employer's books until those amounts have been paid. So our journal entries can get quite long. You debit the salaries expense and then credit all of these current liabilities. The salaries expense amount is going to be your gross pay, and then all your taxes and voluntary withholdings are deducted until the employer is left with the net pay, which is recorded in a credit to salaries payable. The follow-up entry is a debit to your salaries payable and a credit to cash because now the employee has been paid. Now taxes are everywhere and on everything, so let's look at the employer's payroll taxes. So the employer's taxes are FICA, the federal unemployment tax that we are going to call FUTA, and the state unemployment tax that we are going to call SUTA. So our journal entry for our employer payroll taxes looks like a debit to payroll tax expense and then credit all of these taxes payable. So when an employer is accounting for all these employee benefits like vacation pay and pensions, they are estimating this liability because it is a known liability with an uncertain amount. So debit employee benefits expense and then credit the benefits like medical insurance or retirement programs payable. Vacation benefits are going to be their own journal entry where again we estimate this expense and credit the payable. If the employee actually uses their vacation days, we debit the payable and credit our cash to pay them for their absence. They are not mandatory, but when an employer does offer bonuses to their employees, they will debit the expected employee bonus expense and credit the payable. The warranty on your AirPods means that you as the consumer are able to bring back your AirPods to the Apple Store to get them fixed or repaired, so long as you're within the warranty period. The seller will estimate the warranty expense based off experience and debit this account and credit the estimated warranty liability when they sell a product with the warranty. So if you do bring in your AirPods to get fixed and you are within that warranty period, Apple will debit their estimated warranty liability and credit their asset account, parts inventory, or whatever they use to make the repairs. A contingent liability is a possible debt that depends on the outcome of a future event. You see this most commonly in lawsuits. If you are being sued and you lose, you owe money. You will only record a contingent liability if that future event is likely and you can reasonably estimate this amount. Income taxes and vacation pays are pretty likely for an employer to pay, so they are going to reasonably estimate this amount and record these contingent liabilities. If the future event is possible but it's not super likely, you will only note this in the financial statements, but you're not going to actually put a dollar amount to it. And if it's unlikely, then don't bother disclosing it. Our ratio for this video is the times interest expense ratio, which will take your income before interest expense and income taxes and divide it by your interest expense. This ratio shows how many times a company's earnings can cover its interest expense. And that's the basics on how you account for current liabilities. So go down below to find my free practice worksheet and free downloadable study guide, and give this video a like and follow.